So apparently my earlier message to you didn't send. I'll have to check and see if I got the right phone number. Anyhow, this is a quick tutorial on technicals and people who trade based on what's happening with the chart as opposed to the underlying fundamentals of Zillow in this case. Is Zillow going to make money? Are they going to lose money? Are they going to have more competition? Are the prices of Zillow being affected by institutional investors buying or selling, inside traders buying or selling? Those are the fundamentals. Technical traders don't care about the fundamentals, whether a company is profitable or not. Otherwise, you wouldn't see companies that are highly valued that are losing money. The reason that they're highly valued is because they're being traded on based on their technicals. And there's a number of things to look at. Here's a chart with no technicals on it. Here's a chart with moving averages on it. This smooths out the ups and downs of the price. This is the blue dashed line is a 50-day simple moving average that just takes the last 50 prices and averages them and plots them. This is a 50-day extended moving average, and it weights the prices for yesterday heavier than the price 50 days ago, so it'll change faster than a simple moving average. And that's the same for the 200-day moving average or the 200-day extended moving average. I look at all four because some traders trade on this extended, some trade on the simple. When a stock gets away from its 50-day moving average, things tend to revert back to the mean. You're a musician, you know that music is highly influenced by mathematics. The market is extremely influenced by mathematics. Things tend to revert back to the mean so that you see stocks coming back to their 200. As you see this Zillow back here getting resistance at the 200. That's called resistance, where it hits the 200 and it drops. Or here it goes up and it comes back, loses its 50, loses confidence, goes down to the 200, loses the 200, loses confidence again and drops. So moving averages are important. Then you have things called Bollinger Bands, a mathematical formula invented by John Bollinger that shows you the standard deviation that a price could move based on a 95% probability. So today, Zillow could move as high as 90, it could move as low as 76, based on confidence factor of 2 standard deviations relative to what it's seen in the past. So you can see that stocks tend to trade within their Bollinger Band ranges, and it isn't very often that they trade outside of their normal standard deviations. When that happens, sellers come in. Look, we had 2 days in a row here where Zillow was outside its Bollinger Bands. And if you were holding Zillow that day, you knew this day that it was going to go down the next day. Well, it did, but it's still above the Bollinger Bands. Well, the next few days it really dropped because buyers said, hey, it is just overbought. The chance, if it's outside of its 95% probability range, it's 90 or 95%, then chances are it's going to reverse. And that's the same here, where it fell out of its standard deviation range. So buyers knew that this is probably a good time to buy because statistics just says that the price is going to go up. So Bollinger Bands people look at. They also look at SMIs, which is stochastic momentum indexes, which measures the rate of change of price. And this is the fast moving rate of change, which is based on 14-day numbers, and this is the slow, which is based on 40-day. These are the standard ones. You can change them. Some people use 11 and 35, 14 and 40. The best thing to do is not mess with the numbers that are provided in your trading platform. But this tells me that Zillow is on its way down for the long term, and certainly on its way down, but maybe it's gone down as far as it's going to go before it's going to move back up. But its general trajectory over the next 40 days is down. Look what happened here when it was this high. It meandered along and it stayed high, and the stock still kept moving up. And then it signaled, well, stochastic momentum says it's going to drop. And sure enough, what happened? It really did drop. And that, of course, is COVID-19. So in the period of time that this moved up, the slower moving momentum index moved up, the underlying index moved up and down, up and down, up and down, up and down. But the overall effect was that it kept moving up. So as this moves down, you're going to see the momentum index going up, down, and it's by these minor changes in the daily rate and how quickly they happen, how fast the changes are, how big those candles are. But overall, this looks like it's going down. Anytime it's been at this level, it's gone down further. Here, it went down way further. Here, it went down further. So this basically says, if you're interested in a short-term profit, take it. And you can either sell it at the price you want to today, or you can put what's called a trailing stop that says if the price drops $1, I want to sell. If the price drops 50 cents, I want to sell. So if the price is $83, and you say if the price drops $1 with a trailing stop, when it gets to 82.15, an order will be triggered and you're out. If the price goes up to $84 today, your trailing stop will move up to $83, not 82.15. So if the price drops $1 from 84, then you're out. So as the price goes up, your trailing stop goes up. It's a very safe way to get out and make as much money as you can if you were wrong. If you sell and the price goes up, then a trailing stop was probably what you should have put on. Google trailing stop and what is a trailing stop. Another one people look at is the Ichimoku cloud, and I use this a lot. This is a Japanese trading system that's been around since the 1800s, was developed by rice traders to determine what the future price of rice would be based on the historical price of rice. And it's amazingly accurate, but it really takes a long time to learn and understand. So people typically start with moving averages. People also look at technicals and shapes, which is trend lines. And you tend to see a stock hitting a trend line, and buyers and sellers will be at that trend line ready to sell. So in here, if somebody had put in a trend line, says, I'm going to sell when the stock hits this trend line, they will start with a 2-point trend line, which really isn't a trend. Trends are 3 points, but here's a reasonable, almost 3-point trend line. So you could take that and say extrapolate it right, and you could see people who had that trend line back in February, when it hit in June, they sold. When it hit again in July 22nd, they sold. But when it passed this trend line, they bought, and it moved up tremendously. So trend lines are extremely important. If you can spot trend lines in a stock, they're going to tell you when to get in and when to get out. They're really, really good. Now here's a very steep trend line. If you take this and try to match all those points and say that's a trend line. Now look at that trend line. Price went up, came down, started a trend, right? Just 2 points here. Let's say we spot an upward trend right here. There's a trend. 1, 2. Now we have a trend line. And the reason I didn't pick this one is because it's so far away from this bunch of lows I decided to ignore that low and just take this one. So now we would say, okay, that's the trend line that I want to follow. I'm going to extend it. And if someone had drawn this trend line back in April, when they had support here and it bounced up, they would have held on to it. Came down to here, say, oh, should I get out of it? Should I sell? It's going down. Well, I've got this trend line. People are going to be watching that trend line, and they did. When they came down to that trend line, they bought. Look at the volume. The day that it hit the trend line, the days before it hit the trend line, up, started to move up, came down to the trend line. People still held. It went down a little bit, but it did move up by the end of the day. If people were trading by the 15 minutes, they'd have gotten out. If they were trading by the day, they would take what happens at the end of the day. And you can see we've not ended below this line yet. Here, it failed the trend line, and what happened? It went down, but it caught support on the 50-day moving average. Came up to the trend line. Sellers were sitting there. And they sold it until it came down to the 50-day moving average. Then they bought it again. Then it went up, hit the trend line, people sold it. It hit an 8-day moving average. 8-day moving averages are powerful as well. It caught support there, moved up, hit the trend line, moved down. So now, of course, you say, well, where's it going to go? The trend line, I'd be out of it now. If I were a trend line trader, I'd already be out. So there's no point in saying, should I hold on to this? Because it might come up to the trend line. If it does, there's going to be sellers there. So that's wishful thinking. If you're a trend line trader, you're out. Not on this candle, but you're out. If not this candle, then certainly the next day where you have confirmation, 2 red days in a row, tell you that's confirmed, out of there. That's trend line trading. There are all sorts of other trends. There are, believe it or not, there are patterns called Gartley patterns. And you must love mathematics. Let's take a Gartley pattern. Let's see if there's a Gartley pattern in here. There isn't. But a Gartley pattern would work something like this, where I would take, there's no Gartley pattern in there. Let me just draw a Gartley pattern and show you what it might have looked like. No, I can't, because there isn't any. Anyhow, they're 5-point patterns, down, up. Once it's finished 3 of those points, you're almost guaranteed it's going to the 4th. And if it goes to the 4th and changes, then you're pretty much guaranteed it's going to the 5th. It's scary. Once you learn more about technicals, you would be amazed. And there is nothing random about the market. There are so many computers trading. 70% of the volume on most stocks is generated by computers. And they are using trend line signals. They're using stochastic momentum indicators. They're using, here's the number of studies that are available. Look at them all. It's unbelievable. There are this many studies that people will use or that algorithms will use to make buying decisions. The most popular are trend lines and moving averages. The most reliable are trend lines and moving averages. The last one I want to tell you about, and if you're a musician, you probably know something about Fibonacci ratios. Fibonacci ratios, nothing seems to be working. Let me draw a Fibonacci. Let me take a retracement Fibonacci. There we go. So it says this wave, this down wave, which went from here to here. If this is going to move in a harmonic manner, like ripples in a pond, then as it moves up, it's going to meet resistance at these Fibonacci numbers. I don't like 14.6, although you can see that it's important because it moved past there and came back and found support at 14.6. Like it came up and came down and found support at 23.6. Watch them if you want. I'm a long-term trader, so I don't use these minor Fibonacci's. But what I do love is the 38.2 and 61.8. And if you add both of those up, they come to 100. Forensic scientists can determine the age of a body based on the length of the femur, because the length of the femur is in a Fibonacci relationship with the height of the body. So I like looking at 68, 38.2, 61.8, 78.6. Look how important 78.6 was in order for it to recover all of its losses and get back to this 100% value. It went up, found resistance at 50. So if somebody drew a Fibonacci here to here and said, I'm going to buy this stock on its way up based on Fibonacci's, they would start buying now. They would sell at 38. When it came down and maybe bounced off of this other Fibonacci, they would buy, sell at 38, buy at 23, sell at 38. Oop, I sold too soon. Jump back in again, sell at 50. It goes down. Comes down to the 200, buy again. Goes up to the 61.8, but it blasts through the 61.8 all in one day. See, from here to here. But where does it stop that day? The 78.6. Sell, get out. And it comes down to the 50. Got 50% support. Buy it again. Goes up to where? 78.6, but this time it's strong enough to drive past that and almost make the 100%. But sellers who expected to go to 66.8 but don't want to be caught in the flood of selling will set their point of sale just below the Fibonacci and get out before those who are waiting for their full 100% return. And then it went down, played around with the 78.6, but it came up to 100% again and then started to chatter. That's a good sign. Now it's not dropping at 100%. And it's staying there for many days. After a number of days of it staying there, you want to buy. That's another technical pattern in there, and it's called a flag pennant, where there's your flag. Your flagpole is here, this big move up here, and then you've got this little wedge here, where the price gets narrower and narrower and narrower, the price range gets narrower. I'm going to draw you if you're still with me, if you haven't fallen asleep, I'm going to draw a little wedge pattern for you, and it looks like this. Let me get a proper wedge tool in here. And where are my wedges? Come on, where are my wedges? I don't know. Where are they? Anyways, I should know. I use them often enough. There we go. Angle wedge. So I'm going to go in here. There's my flagpole right up here to here. And I'm going to take that. I'm going to move it around the other way. And I'm going to say, there's my little wedge pattern. I'm going to bring it in here. Whoops. Draw. This is really what traders do. And they draw this wedge pattern and they see it moving in that wedge, and then when it breaks out of the wedge, they buy. And where does it come down to? Test the top of the wedge, and then you just buy more. And it goes up to 114.6, again, another minor ratio that I don't like. This one I don't like. But 127.2 I do like. 138, 150. Now it's hit 161.8, and that's a big growth. But that's another, this is called the golden ratio, 161.8. This is the most important ratio in the Fibonacci system. And again, sellers were hiding just below that because they didn't want to be caught in the stampede of selling. And they, in fact, drove a stampede of selling by setting their stop just below that. So this shows you that you throw a rock into a pond, you're going to get predefined ripples that expand as you get further away from where the rock went into the water. Those distances are Fibonacci distances, and they are darn true in the market as well. Nothing is random about the stock market. So, message about Zillow, probably should have gotten out here. Now would be a good time to get out. Wait till it comes back to 78.56 if you really want to buy it. But if you think the market is going to sour for a while, buy it again when it shows support at 74.40. If you've made a profit, there's nothing wrong with taking a profit. If you've made a loss that exceeds your comfort level, there's nothing wrong with taking a loss and relieving yourself of anxiety and being able to sleep at night. Take the loss. If the stock goes up the next day, do not regret any decision you've made. Just learn from that decision.